Hi everyone, this is Don Mahoney with the Millionaire Maker Advisory. Today we're speaking to Ivanhoe Nathaniel Smith, principal at Corral Island Group. And today's topic, we're going to cover platform investments. We're going to cover just what they are, how do you get involved, and some of the things you should look out for. Well, how are you doing today, Mr. Smith?
Excellent. How are you?
I'm doing great. First, tell us about the Corral Island Group.
Corral Island Group was formed 6 years ago. We are registered as a private investment company. We act in that capacity as a consultant to clients wanting to do hedge fund transactions, private placement transactions, venture capital transactions, and private equity transactions. In addition, other clients may want to purchase or participate in commodity transactions such as purchasing jet fuel or diesel fuel for their own consumption or for trading purposes.
Okay, that sounds like a lot.
Not really, they're all intertwined. They all touch each other.
Okay. Now, how does one get involved with becoming a client or participating in some of these investments? And what kind of returns are we looking at?
Most of our clients are clients who have projects that they want to fund or finance. The projects tend to be, or the minimum I should say, is in the 25 million area, but the sweet spot is somewhere around 100 million plus. So a client may have a need to build some project requiring $100 million. And he may not have $100 million, but he may have access to either a commodity or a financial instrument such as a BG, MTN, medium-term notes, bank guarantees, or sovereign bonds, sovereign debt being the debt of a national country, the national debt of a country. Typically, the names we see in sovereign debt are Brazil, China, Venezuela, and Mexico. Bonds like that, we can monetize them. Monetize means we take a bond, we value the bond, we lend against the bond. The usual lending rate, LTV, loan to value, is about 60%. The client gets a use of that money for 1 year, and depending on the transaction and the way the contract is written, the client has the option of not paying that money back or to pay that money back. It's called non-recourse, not paying the money back, or recourse, paying the money back at the end of 1 year. In that year, that client has use of that money to fund his project. But you can do the math and see that with $100 million worth of bonds, and a project may be $100 million, when you do an LTV of 60%, you only have $60 million. So to make up the difference, we take the proceeds of the LTV, being the $60 million, and put those proceeds into a private placement trade, which is a pre-arranged buy-sell contract involving financial instruments or fuel that the client itself, who puts the money up, faces no risk, but the product is purchased at a set price and contracted to sell at a set price over the year period. Depending on the size of the transaction, let's stick to the $100 million level. At $100 million, we can get you a minimum of 100% per month return, or in certain cases, certain special cases, we can get you 100% every 2 weeks, just because the underlying asset is locked in. The underlying asset in the cases I just mentioned could be medium-term notes, or they could be commodities or fuel.
Now, just let me jump in real quick. A lot of people have a tremendous interest in historical bonds. They've been hot lately. I noticed that you didn't list historical bonds when you were going through the particular assets that you could monetize. Why is that?
Because there's a great deal of fraud in historical bonds. And we do work with historical bonds, but not as freely, I would say, as with the other assets are listed. We will consider historical bonds, but the requirement for historical bonds is so strenuous that many clients who think they have historical bonds actually have fraudulent bonds.
And regarding the BG, can you monetize a BG in which the BG is leased?
Yes, we can do leased BGs and fresh cut BGs, not really fresh cut, seasoned BGs that are owned by the client. Fresh cut BGs are too fresh to have the capacity to gain the value that they gain by seasoning. But seasoning only takes about a month to do so.
Right. Okay. So now you were talking about the different programs and the phenomenal return that one can gain from a $100 million investment. But a lot of people out there.
Now let me temper the disbelief.
Okay.
The reason our website is www.corralislandgroup.com.
Okay.
On that website, we give in detail and legally all the rules and regulations and reasons why private placements exist, how to get involved, and what the requirements for getting involved are, what the paperwork, administrative requirements for getting involved are. One thing you need to remember is that private placements are designed to be a method of project finance. So at the end of the transaction, there has to be a project there. So it's not just making 100% per month or per week or per every 2 weeks, whatever the strategy is. And they're different because at different times of the year, different transactions occur. And once you're a client in a system, you pass compliance and you're good with the trader's good with you, the trader will call you and tell you that there's a special transaction happening, the returns of in excess of the traditionally advertised transactions, and they would invite you to participate in that transaction. So the returns could be ranged all over the place. The returns I gave you were the returns most typically available any day of the week except in August to any applicant who passes compliance. So let's go back. The Marshall Plan. The Marshall Plan came about at the end of World War II, and the Marshall Plan went into existence in about 1948 to help Europe rebuild as part of the European Recovery Act. And what these countries, they was put up money to be traded and using financial instruments to expand the money. I think the total pool of money put up to fund the Marshall Plan was about $168 million. That money was traded by the banks, by everybody coming from the countries involved.
The central banks of those countries.
All those countries got together and they traded back and forth and raised that money to 16 to 20 billion and then further. So they had the money to start to rebuild Europe. The question automatically comes up, why don't we have a Marshall Plan private placement program in America? Great question. Go see Congress. Above my pay grade. So,
now, how does that plan differ from some of the derivative activities that a lot of the investment banks were doing and kind of crippled the European Union?
Totally different. Totally different. Derivative products, derivative trading products are strictly investment vehicle. There's no project requirement behind that. And let me say something about projects. If, for example, you are the client and you bring $100 million to the table to participate in a private placement, your $100 million is accepted, you pass compliance, and you start to trade. We start to trade on your behalf. Your return is 100% per month. You are making $100 million per month. If you take as required a percentage, typically the percentage of the proceeds that you have to place into a project is somewhere between 60 and 80%. Okay? So if you take that 80% and place that money into a project, and a project could be a nonprofit project or a for-profit project. Once you make the investment in that project, you own the project. So the proceeds and the returns from the project come to you. The reason they have the project in there is so you can help with that money create jobs. So jobs are created by you funding your project getting started. But if your project involves real estate or construction or an entity, building an entity and operating at that entity, you can see that that calls for job creation, which solves that problem, and you own the entity. The best thing is if you invest $100 million in an entity that you own and manage for the benefit of the people and yourself, in 5-6 years, that $100 million entity has additional value.
Absolutely.
By growth. Okay? So, in addition, you have still about 20% to 40%, depending on which number we settle at, of cash that are coming off the private placement that has no investment requirement except paying taxes.
Now, the Marshall Plan addressed the issues regarding Europe and its reconstruction and redevelopment, but 1948 is a long way away. Why do we still have to adhere to a project-based scenario on a plan that's kind of antiquated?
That's a global financial decision with the IMF, the World Banks, all the collective central banks got together and decided to keep that concept so that similar projects around the world can be funded. For example, when we get a hurricane or tornado or monsoon anywhere in the world, the first money that's put together to help repair that country is coming through private placements. So it's a vehicle that we use all the time, unknown to people who are not in the business, to come up with the money to correct whatever may happen, be it war or a natural disaster. That pool of money is there to do that.
Okay. Now you talked about compliance. A lot of pushback from a lot of investors out there that have unfortunately have been duped by companies like Berea or Rudius. Why so much disclosure of personal information? It seems that the broker or the principal at the investment fund has the upper hand as far as your personal information. What are the things, is all that information really necessary? And what are the things that investors can do to protect themselves?
All the information is necessary, and you can confirm that on our website again. There's the rules of the road and all the legal regulations coming from the U.S. Treasury covering private placements, all the requirements. The reason that it's so stringent is to protect both the investor and the trader. There's so much fraud out there. Because of this internet age, your information can be just snatched off the internet in a second, and a false profile be created. So we have to conduct a compliance process that proves you are who you are, number one, and you know this is going on, number two, and you agree to doing this. Many times we get packages stating that Dante Mahoney wants to do a $500 million transaction, and the compliance process requires that we speak with Dante Mahoney, and Dante Mahoney says, I have no idea this is going on. Because someone, whether from a canceled check or something, got on your trail and created this profile, and is out there, unknown to you, engage in this process. But they would never engage. You had to go through Treasury, Interpol, FBI, and the trader to get there. The biggest drawback from this program that I've seen over the last 5 years is that we get about a 90% reject rate.
Wow. Based on
something.
Okay.
Something in the profile of the person, plus additional fear of money being misused and misdirected for nefarious purposes like terrorism. Mm-hmm. So the error we have seen in the industry is the error on the safe side and be overcautious rather than lax.
Right.
So we have about a 90% reject rate. Now, when you get rejected, depending on why you get rejected, my advice, if it's nothing major, just reapply. Okay. Typically, the reject rate is a client who says he doesn't want to do this or doesn't want to do this, or he did this before and this didn't work. No, these things happen. It's not easy to get into private placements. It's worth the effort. It's worth the time. If you're interested, come to us. We'll walk you through it before you start, without the promises that other people make before they even get you through. Our focus is on getting you to compliance. Once you get to compliance, then the goodie bag is open, and you can go shopping for the private placement strategy that meets your needs and your timing. To talk to and about people who have not gone through compliance is kind of like a waste of time. Right. You know, it's nice to feel all warm and fuzzy about how you invest the dollars you make, but until you pass compliance, no dance.
Now, do you offer services to help guide a person, not only through compliance, but through the selection of the proper investment?
Absolutely. We get compensated on a commission basis with a successful placement and the client earning money. We earn money when the client earns money. That's number one. Number two, it's in our best interest to walk the client through every step of the compliance process, keeping them informed of any shortcomings in the application. To do that, we review the application first to make sure all the checkpoints are hit before we submit. By the time we submit our client's package, that client is good to go. If your package comes into us that we're even the least bit worried about, we don't submit. We don't take you through the process to have our traders come back and say no. When we submit it, it's 100% that it's going to work on that level. But that takes a lot of dating. For example, you cannot submit a package that is more than 3 days old. Now, to coordinate having all the documents signed and to us within 3 days is not easy. So sometimes things get back because they're outdated. What happens when compliance starts? When compliance starts, all the trader and his staff are going to do, check what's before them. Then they're going to go back and call everybody to verify and use their methods, again, Interpol, FBI, Treasury, central banks, those databases, to make sure you haven't stolen this money, it's your money. You made it, and not going to do anything, with it that would cause a problem in the future. Once you do that, then we're ready to go in discussing what the options may be at that time. And the options are all over the place. Not just the invest and get 20% a month or 20% a week or 30% a week. The returns range from high risk to low risk. Steady money, which is a lower steady number, to bullet, what we call bullet money, 6-7 days in and out, 100% per day. If available, you got it.
Now, how can people be sure that you're a reputable organization?
Well, number one, we're registered in Delaware as a private investment company, but my personal background is I am a chemist. My undergrad is in chemistry. My graduate is in business from Harvard Business School. I worked, following undergrad, I worked in the chemical and oil industries, working for names like Celanese Chemical, Standard Oil of California, before going to business school, and then after business school working for Morgan Stanley as a bond salesman and trader for 8.5 years before retirement. And then we being myself and my sister, formed our company in Connecticut. The name is Smith Wiley Company, and that's a private equity firm. We have about $400 million in the management there. And I'm here in Philadelphia working with Chad Washington, my other partner, to construct Corral Island Group. At every level of my history, I passed compliance. So you can, I'm an open book. You can check me out. FBI, Interpol, they know my name by now.
Okay. All right. Now, a lot of people don't have $100 million, $25 million. Are there programs for people at a small cap level?
Here's the difference. At $100 million, your money stays in your account. And what's done is that the trader each day pings, that's an industry term, we call it ping. That means he calls at the bank and says, is the money still there? Yes. He then goes to his bank and borrows against your money and goes to trade. And that has to happen, that ping process happens for the life of the contract as specified in the contract. What do I mean by that? The contract could call for 10 months of trading. The first month, you put 100 million in, the first month your return could be 100%. The first month you get back $100 million. Your ping is good for 1 month then, because the second month, the profits will be used to replace your first 100 million and ping from your profits. So you can actually take profits by the third month. Okay? Or mid-second month, something. Now, less than 100 million, the sweet spot is 100 million, begins at 100 million. Less than 100 million, you have to combine assets. You can combine assets in a number of ways. You can leave your money in your account as your sub-account, you're in your control, under the master trader's main account. Your sub-account under their main account. You can do a smaller program. The smaller programs tend to have way less return, not 100%. It may be 10 to 15% per month, just because of the volume. Or you can do a trading program that's called an appreciation program, where you get no profits for 4 months, and the trader just trades and trades on your profits.
They compound.
Compound it to get it to the $100 million level. But even there, you don't have control 100% of your money, because the money has to be moved to a trader's account. The minute you have to move your money to somebody else's account, there's a risk of fraud. So How do you do that and get around it? You have to combine your resources with other people and enter the program as a fund or as a company. Or you and your compadres get together and put up whatever it takes to put up $100 million. The safest way to do, get a group, form a company, form an LLC, sell shares to each other, and enter as that company, as that LLC. You can do it the other way, but there are risks associated. The way we like to tell clients to do it is the $100 million level is the way. But I understand that the $100 million level is tough. But we've found success in having clients understand that there are risks at the lower levels. Many people talk about the lower levels like it's nothing, but the lower levels is where all the fraud goes on. If someone can hit you for $2-3 million at a clip, you're not really going to tell your friends too much about that. But they hit you for 25. That's
that's news.
That's news.
Okay. So, are there any programs right now that, for let's say, first-time investors on a private equity platform?
No, but the strategy, having been in this business and seen clients wait for programs to come and run to get the program, only to find out the programs are gone. What happens when the program is announced? What happens when the program is announced? The trader goes to clients who he or she has done business with before first, and introduces the new program, give them the opportunity to participate, and then if they don't want to, or they take a small piece, what's left comes to us, the first timer. That means it's a feeding frenzy for the 50% or 40% of the program that's left and is filled out quickly. The way we found out that works is fill out the compliance documentation. Enter the program. The last part of the compliance is how much money you want to invest. Put that number in, 2 million, 3 million, whatever. Put that number in. You have passed compliance, your number is known, and the trader may allow you, because you passed compliance, to piggyback on a bigger trade. What's piggybacking? A client comes with 100 million, the trader will have no problem adding your 2 million to his 100 million. You get the benefits of 100 million. Meaning you get the return of your 2 million, 100% per week, per month, whatever was designed for that trade, that client. And your money's protected.
Right. Now, are there any programs or instances where you can have your money in your account, and when it's time for those funds to be traded, those funds in your account are just blocked?
Yes, but again, the size of the program and the return of the program all dictate that.
Okay.
Sometimes you can block it, sometimes you can't. But yes, again, the key, before you go shopping, pass compliance.
Pass compliance.
Once you pass compliance, you got the key to the store. You can go shopping and find some clothing that fits you at the time you're shopping.
Now, what about risk mitigation? I'm sure that you do some due diligence with who you work with, or I'm sure you're just not taking any old program into your fold and presenting it to investors. There's some sort of due diligence on your side as far as who you're going to do business with. And how does a person protect themselves further, either through insurance wraps or some other means?
There are 12 master traders in the world. 12. Every private placement program is traded one way or another through one of these 12. We are direct to one of those 12, a gentleman who's based in Spain. Okay? backing down from the master trader, there's a bunch of people out here who offer trading programs. The question to ask the person who offers you a trading program is, are you direct or do you have in your company a master trader? If they don't, that person offering you the private placement is what's called a facilitator. That means he offers programs, then takes everybody's program in one nice bundle and enters a program, enters a trading concept, a trading strategy, using a master trader as the guy. It's his program now. He's the entry. And you are sharing it with him because of his context in this transaction. You're not direct to the master trader. You're direct to him, the facilitator. He's direct to the master trader. In our way of doing business, you're always direct. Once we get you through compliance, we're out of your way.
Okay.
It's you and them. But the key again is compliance. Now, does fraud happen? Yes. Have I seen it? Yes. In 6 years, we've conducted due diligence on maybe 30 groups that claimed they were traders. They claimed they were direct. And only in the last 2 years do we get everything together to find out and confirm the 12 master traders in the world and deal directly with them. Another thing that people tell you is that the whole process is a quick process. We'll get you through compliance in a week. Not gonna happen. It takes more time to get somebody to answer from the Federal Reserve in a week. That they may not respond to you in a month. Let alone FedEx, central banks, Interpol, and FBI. So plan on 2 to 3 months compliance.
Really?
Yeah.
Wow.
Outside. If it comes in earlier, better. Sooner the better. The big numbers, of course, get more attention early.
Of course.
The big thing I've seen, the big problem I'm seeing is having a client put up $2 million, $3 million today on Tuesday. On a Thursday, another client puts up $200 million. The $2 million client gets kind of pushed aside for the $200 million client.
Right.
And the $2 million client has to wait to get another $100 million with him. The $200 million client goes right to trade. So the $2 million client gets forgotten. So those kind of things we do. We monitor where you are in the compliance process until you get all the way through and right face to face.
Okay, now what about the insurance wraps or some other means of protecting your assets?
Well, there are programs, once you get through compliance, that the trader offers where he pays for the insurance wrap, or he can do a program where you pay for the insurance wrap. This is all, again, in the area I would term product selection. You can get any project, or any product rather, customized to fit your needs or your compliance, your personal compliance requirements. If you require insurance wraps, they will do that.
So you can go outside and get your own insurance?
No, you can't go outside. You will work with the trader, and as long as the trader understands that if you suggest that I have an insurance carrier who's willing to wrap this trader, if that insurance carrier is acceptable to this trader, that will work. But he will not take just any wrap. But once you get in and you talk to the trader and you set your parameters and you talk about the all-knowing contract and what needs to be in the contract, those issues come up and they're settled.
Okay.
But wraps are in no way out of the question. You understand that wraps reduce return.
Absolutely.
Man, we're good.
I don't think a lot of people out there are aware of it, but yes.
Reduced returns significantly.
Yes.
Now, I'm talking about from 100% to maybe 50%.
Right.
And 50% is still pretty good.
Yes. Okay. Now, tax consequences.
Now, I want to say one more thing about wraps.
Okay.
When you put an insurance wrap on, you're transferring risk from the trader and the transaction to the insurance company.
Right.
You're just transferring the risk. The same risk that you may have perceived at the trader level may be inherent at the insurance company level, and you're paying for protection that's not really there. As you know, insurance companies are notorious for leverage.
Right.
And for borrowing money or convincing you that you're protected when you're not really protected. So you got to keep that in mind. You have to approach insurance wrap just as you approach buying insurance for your home, your car, yourself.
Mm-hmm. Good point. Good. What about the tax consequences of these tremendous capital gains? Is that something that Corral Island Group can assist clients with?
No, we're not tax advisors. However, we do work with legal firms who are legal tax advisors, because the tax bowl of goulash is extensive. And depending on which country you trade in, which country you choose to get your money in. For example, if you get your money, your cash in America, and you don't invest in America, you're subject to 50% tax unless your particular transaction comes under a predetermined, pre-executed tax treaty where the tax is about 14%. The only way for you to know that is at the time when you sign the contract, discuss the tax issue with the trader, and we'll know which country to reroute the money through. For example, you could end up never taking your money here. Instead, you would get a debit card in a Swiss bank, or a Spanish bank, or a London bank, or a Hong Kong bank, for you to draw money on and write checks on to fund your projects.
But you'd still be subject to the tax jurisdictions of those, the tax statutes of those specific.
50% in America, 14% in London.
Okay. Now, with a lot of the volatility in the market, are these trades? You know, you suggested that a lot of them are buy and sell.
Right.
Are these trades even possible with such volatility?
Volatility has nothing, zero, nada to do with it, because it's a buy-sell. What happens is the trader lines up, before he uses your money, he lines up if the deal is going to involve medium-term notes. He lines up with the issuers of medium-term notes to buy $10 billion worth of medium-term notes over X amount of months at this price. At the same time, he turns around and lines up to sell $10 billion worth of medium-term notes to pension funds. He executes A and B within a nanosecond and just takes out the spread. And he splits the spread with you, the investor. There is no volatility. If there's no trade, the reason there's no trade is because the banks, the largest issuers of medium-term notes are the banks. It's because the banks do not want to invest. Your question should be, how can banks issue this much paper all the time? It's called off-balance sheet financing, which never hits the balance sheet because it's called off-balance sheet. Right. So on a daily basis, the banks come in the marketplace to raise $20 billion of capital every day.
That's why the accounting never adds up some kind of way.
Well, it's not supposed to because it's off balance sheet.
Right.
The balance sheet is what stocks are based on. This stuff is over here.
Right. You know, and why is that? I mean, surely there should be some sort of regulatory process to kind of micromanage that, because obviously anything can happen.
There should be, but there isn't. And I would say the reason that there isn't is something called the power of the lobby.
Okay.
And you don't have a lobby. The bank does.
Right.
It's that simple.
Now, generally, what's the spread that a trader will
20
take?
points.
20 points. Okay. And the brokers and every other party in between, what is their
Usually about 1 point, but sometimes a 2 to 2.5%, or 2.5 points, depending on the transaction, the size of the transaction, which trader or which trade the trader recommends for the client. We don't know what the split is until the client signs that contract. After being presented with the contract and reviewing the contract and working out any issues and signs it, then the trader will tell us it's 1%, 2%, or 5%,
right.
whatever it is. He will tell us the smaller amounts, the number might be as high as 5%. When I say 5% or 1% or 2%, that's half sell side, half buy side, okay? So if it's 2%, it's 1% on the sell side, 1% on the buy side. The buy side is the client. I get paid on the buy side. So it's 1% for all the brokers on the buy side. So if you bring clients to us, we have 1% to split between you, me, and Chad, and anybody else in the group who bought maybe somebody may have bought into you. And that gets 1% divided by 4, if it's one person or 2 people, whatever. And the other percentage goes to the trader side, his people. Because once he signs off on accepting something, he has his people who he has to pay. So that's 2% out of the return. And then the trader splits the profits in some predetermined way with the client, such that the client ends up with his agreed to return for the time frame. And he does that maybe 5-6 times a day,
Okay.
4 days a week. On Fridays, they reconcile the books. On Mondays, they pay out commissions and returns to clients. Or every other week, as agreed. Some clients say, I don't want the money every week. I want it every 2 weeks. This allows the trader to compound for just a week. And you know, when you're talking about hundreds of millions of dollars, 1 day compounding,
Right.
1 hour compounding.
Yeah.
Okay, so.
Now, before we talk about some just general topics, quickly, is there anything, I mean, we know that August is not the good time to jump into some of these programs.
Actually, August is a great time.
August is a good time.
Because the programs are just getting, they're being formulated now for September. So now's the time to submit your package and go through compliance.
Okay. Anything that you could recommend for some small and some large cap investors?
Get the compliance.
And let's address that. Define small cap versus large cap, because there's a lot of confusion out there for a lot of folks.
It depends on the trader, but small cap tends to be anything under $100 million.
Okay.
Anything over is large cap, but some traders go down to 1 million.
Right.
Okay. But those, I tell you, the $1 million trades last the afternoon. By the next morning, they're oversubscribed. That's how fast they go. Because the 1 million trade is a starting point for a lot of people.
Right.
That $1 million trade will turn into, in 10 months, $16 million. And then the next year you enter a $16 million trade, which in 10 months will turn into $300 million.
That's with compound.
With compounding. In 2 years, you'll be at $300 million. And then you can take money out and
do whatever you need to do.
And still be in additional programs to continue what your long-term plan was.
Beautiful. All right, the Fed.
But the key, if I drive home nothing else, past compliance.
Well, you heard it, everyone. Past compliance. Can't get anything done without that.
Right, correct.
Where do you see the Fed and Janet Yeltsin's role as she moves forward? Tapering or non-tapering? What do you think is going on? We had a great market for some time, and then we've had the recent 300+ point drop and an additional 160 point drop. What do you think about that?
You know, I was asked last year about the direction of the market by some very, very knowledgeable people, and I told them that I'm going to tell you the same thing, is that the market runs on emotion, fear, and it runs very much on emotion and not one bit on fact. Fact, we have an expanding economy. Fact, stock market is at frightfully high levels. Fact, we're changing over from manufacturing economy to a service technology economy. Fact, there are going to be people left behind that will catch up later. Fear, the market is too high. Well, we've never been here, but we've never managed this type of economy before. So we cannot say we've never been here because we don't know where here is. Here is new, correct?
Right.
So, at this market level, I absolutely advise people to put a hedge on. Don't be naked. Buy some puts. Just in case things don't turn out the way we think. It never does turn out the way we think, but just in case of big time. We know that we've seen it before, we've seen corrections before. You have to make a decision. Are you going to be a trader or an investor? Traders worry about cycles. Investors worry about lifetimes.
Right.
That's the decision you have to make. Once you make the decision, and the decision I make is I'm half trader, half investor. So half the money is for long term, half the money, it's like being at the casino. It's fun. You know, if you win, it's more fun. You know? But it's fun.
Okay.
So I don't think Yeltsin has and the Fed has the impact that they used to have. Do they have impact? Absolutely. Are they going to tighten? Absolutely. When are they going to tighten? No time soon.
No time soon.
No time soon. No matter what anybody says, we still have shaky ground that we built this new economy on. Until we get a full cycle we've got about 10 years, a full cycle of looking back and making some moves. I don't see them, they may move a percentage point, but we're at a quarter of 1% right now.
Right.
The Fed's fund rate is a quarter of 1%. The banks are making money like you will not believe. Your credit card interest rates are averaging 18%. If you go into default, it's 25%.
At least.
Right? If you miss a payment, it's 33%. but the money's costing them 1/4%. So I don't see banks having a problem. You can watch the papers and you can see in the last 6 months, you've seen JP Morgan, Citibank, Wells Fargo pay humongous fines for housing fraud, or housing whatever they call it.
Whatever.
Where they get the money? They wrote a check. They said, oh, will $9 billion do? Here. They all wrote the check, meaning they're doing very well.
Very well. So you don't think that she's going to pull tapering anytime soon?
Well, when in my experience, when people talk about tightening or tapering, they're expecting rather a significant, obvious, blatant change in monetary policy. I think whatever change it will be gradual. It will be like my mother used to say. She was like the velvet hammer. She beat you in submission, but you love it. So I think, yes, we will have to eventually. Cheap money is not going to be there forever, but it's not going to be a jump to 2% or 5% or 6% or 9%. We're 1/4%. So a big move, 100% move would be to what? 0.5%.
Yeah.
That's 100% move. I don't see 100% move. So,
what do you think about the U.S. Dollar and its reserve currency status? Do you think that's going to go away?
no, I do not. No, I do not. I think everybody talks about it because it makes good trading fodder. But as long as we have drone technology and the best, most advanced military in the world, and as long as every single day money from foreign billionaires, including Russia, feels that the safe haven for your money is in America, I don't see it. It's going to be talked about a lot, but if the standard changes, if the standard goes to gold or some other metal, we'll invade the country that has the bump and take it. So,
that's China about right now.
well, no problem.
The yuan has been gaining tremendous strength in foreign markets. You don't see it as a direct competitor to the dollar?
Well, I see it as a competitor. I don't see it as a replacement. Competition is good. Options are good. Options make trading options for the traders and the money makers even greater.
Yeah.
Then we're going to make so much more money when you have another currency or another two currencies that you believe in, trust, you can trade it and know you're going to get paid. That's wonderful. But replace the dollar? I don't see that. Maybe the language should change. And the language shouldn't be replace the dollar or other currencies trade alongside the dollar as standards. That I can see. But replace the dollar? I don't see it.
Speaking of China, where do you see their banking environment going? Right now, their stocks are bottom basement dollars. I mean, they're just bargains across the board. Do you think their financial strength is going to be gained in the near future?
I think we're looking at the wrong thing in China. The thing we're looking at, I think is wrong, is that we're looking at the Chinese government, and we should be looking at the Chinese people. Right now, they have two different stock markets in China. They have the Hong Kong stock market. You and I can participate in that market.
Right.
They have the Chinese Shanghai stock market, which is only for Chinese citizens. Chinese citizens cannot buy Hong Kong stocks. Hong Kong residents, U.S. residents, global residents cannot buy Shanghai issues. So that means the pent-up energy for money to buy stocks is the Chinese people in China who are restricted in terms of what they can buy. The minute that restriction lifts off, they're going to be able to buy McDonald's in LA.
Right.
And the market's going to go up again, big time. So I don't, to me, that coupled with the Chinese penchant for saving, which is renowned throughout the world, has always been, there's a lot of pent-up purchasing power in China. In fact, you can extend that across Asia.
Yeah.
There's a lot of pent-up purchasing power. We don't save. Americans don't save. We live hand to mouth. We eat. We dance. We do it now. The Chinese live for the next generation. They save.
Right.
They used to save because there was nothing to do with the money. Now they have a stock market. Now the stock market is publicly traded. Now they can move around. Now they can buy Nike and whatever in Beijing. The next level is allowing Chinese citizens to use their money and buy any stock they want to. And that, my friend,
it's going to be a whole different market.
it may not happen in my lifetime. It may take another 50 years to do. But that will be when we have a true global marketplace. Imagine how you would act if your government told you you can only buy stock that's issued in America.
Right.
That would not work, right?
No.
Okay. But that's what they tell the Chinese now.
Now, how about shale? There's a lot of development going on with the fracking and shale. I mean, it's big time, not only in the Central Basin around Texas, but also in Canada and even China. What do you see that doing for MLPs and a lot of the petroleum?
The money that's going to be made is going to be outrageous. However, I'm a chemist. I'm a scientist. I don't like shale. I don't like what it does to the environment. I think the cost to the environment is too high, and we haven't even begun to see the cost. But America doesn't run on common sense. America runs on money. Make money now, common sense later. I look at the world, the globe, Earth, as a big orange, and we're sucking the juice out of the orange via a straw. We stuck a straw in the orange. We're sucking the oil, minerals, via shale, via drilling, ocean drilling, whatever. We're sucking it out. Now, when I look at an orange, when you start sucking out the juice in the orange, the orange starts to collapse and you get dents and stuff. And is something going to happen? Is the polar vortex because of what we're sucking out of the earth? I don't know, but we have to stop doing what we're doing. Now, would I say that if we had no options? Maybe not, but we have a ton of options. We have solar, we have wind. We're not exploring that. We're not implementing that. Because the same people who own shale and crude are the same people who control those industries. So the game is rigged already. So we'll never see, those technologies come to fore, which could save the planet. That's my point. Which could save the planet, but it won't. So my short-term and investment answer is buy. My gut tells me, be careful. Okay. It's not good for the planet.
Short and long-term views on gold.
Oh, man. Had you asked me this question 2 years ago, I would have said buy everything that's not nailed down. Now, I don't know. I'm totally confused. My good sense tells me a buy because it's hard to make gold. Okay, so it's a dwindling resource. or what we call in business a shrinking asset. So, but the fundamentals tell me that there's lots of other things to do that make money before you have to go to gold.
Right.
But I would say keep gold, some percentage of gold in your portfolio. I wouldn't concentrate on it though.
Would you take physical delivery of it, or would you just?
No, certificates is fine.
Okay. Final question: what advice do you have for struggling students, fresh out of graduation, or even still in school? What's the best method of preparing for the future, a strategy for saving and investing their money? Or even should they even, high school students graduating, should they even go to college or trade school?
Well, I believe that some education above high school is necessary to function. Whether or not it's college or trade school, that's your choice, but they're not exclusive, mutually exclusive, I should say. You can do both, or do one now and do something else once you understand what it is you want to do. There's a lot of pressure on kids to do this, select and pick now and train for now the profession that they think they're going to earn their living livelihood in. I can only say that that is totally wrong. In your typical life, you'll probably have maybe 3 to 5 different careers, depending on what you feel at the time you feel it.
Right.
So my advice is to learn to think. Learn to add value by thinking. Learn the basics of communications. Learn to be a human being, empathy, sympathy, all these things that you need to function as a regular human being, and be prepared to seek and recognize when you sought something, you recognize opportunity in front of you, be ready to go there and seize the opportunity. It's going to be hard because right now we're going through a major transition. Again, I say from manufacturing as we used to know it to manufacturing today, which is heavily technology based. Right. So if you have no technology background, it's just like the guys who would laugh at the kids who were taking typing classes 30 years ago. Right. Now typing is important, isn't it?
Yeah.
But 30 years ago, no one wanted to take typing. When you had a chance to go to shop, we went to industrial shop or home ec. Nobody took typing class.
Right.
Now the guys who took typing class can operate a laptop.
Right.
Same thing's going to happen again. To me, this is just a way station in terms of technology growth. I really believe that what's going to happen in the next 5 to 10 years, technology-wise, is going to dwarf everything we know up until right now.
You're probably right.
Everything.
Yeah.
It's going to be whole new world. This little, I think we have a small chance to get over, and all hell's going to break loose. I know I have people in Silicon Valley. Silicon Valley is holding back.
Oh, big time.
Because you can't sell something on Monday and have a new one on Tuesday. Right. But literally, they could have a new iPhone every day of the year. That's how fast they're moving. Right. The only area where they're not moving in now that I think is going to accelerate because of technology is medical. And at that point, we may have a problem.
Why is that?
Because we will have solutions for small problems. That would extend the life cycle. That would put more pressure on the pension funds.
No.
And no. You know? And don't eat McDonald's.
Well, I want to thank you so much for your time. We did this the first time, and unfortunately some things occurred, but you're kind enough to give us some more time. And what it all boils down to is, do your due diligence out there, and you know, when you submit your package, it's all about getting compliance.
Correct. Going through compliance. Going through the compliance process. Yes.
All right. Until next time, I'll see you later. Bye-bye. All right. That's it. Done. Thank you so much.
In the words of my Jamaican friends, peace and love, man.
I have to keep that in.